Hello everyone, welcome back to another video tutorial for our exercises from chapter 4 for financial management BUS 223 course. In this particular video we're going to be looking at problem number 7. So let's read it together. It says here are simplified financial statements for Phone Corporation in a recent year, and then they're showing us their income statements and their balance sheets. Okay. And then it says calculate the following financial ratios for Phone Corporation using the methodologies listed for each part. Okay. And then as you can see, we have a list of ratios that we're going to need to calculate. Okay. So this is going to be relatively long, but hopefully it's going to be a very, very useful exercise for you. Okay. So let's start with the first one. First one, A, it says calculate the return on equity and use average balance sheet figures. Okay, so let's come down here. A, return on equity. I'll try my best to write down the formulas for you first before I show you where you can get your inputs for the ratio. From both statements, from the income statement and the balance sheet. Okay, so starting with the return on equity, and the formula for the return on equity is net income divided by shareholders' equity. But since the question is asking us to use average balance sheet figures right here, so I'm going to write it down as average shareholders equity. Okay. Now we'll go and search for our inputs from the income statement for the net income, right? And the balance sheet for the average shareholders equity. Going back to the income statement, here we have our net income number right here, 1223. So I'll go and write it down. Okay. And then for the average shareholders equity, we're going to take, as you can see here in the balance sheet, we have the start of year numbers and the end of year numbers. So we're going to take their average. We'll go down here to the shareholders equity part, and we'll take these two, add them together, and then divide by 2. This is how you get your average. So 9121 plus 9724. Going to put these in brackets and then divide by 2. All right. You're going to have a calculator right next to you. So now I'll crunch the numbers on my calculator, divide it by. So this is 1223 divided by, and then I'll open a bracket. 9121 plus 9724, close my bracket, divide by 2. Okay. And that gives me 0.12979. So I'll round that up to 98. Okay. And then expressing this in a percentage, we're going to get 12.98%. Okay. Now notice this is one of the profitability ratios that we covered. And as I have mentioned in class, it's always better to express profitability ratios in a percentage format. So when you find your final answer, make sure you express it in a percentage. All right. So that's the first ratio out of the way. Now, how do we interpret this ratio? This is, as I have mentioned, is a profitability ratio. So the higher the return on equity, the better. Okay. Okay. Let's move on to the next one. Part B. It says return on assets, and again, use average balance sheet figures. So let's write down the formula first. Return on assets, ROA, equals. Now for this one, we're going to use the after-tax operating income. And we will divide it by, as the name suggests, we're going to divide it by total assets. But the question is asking us to use the average. So again, I'm going to call it average total assets. Just so I don't forget that I'm going to take the average here. Okay, so this is the formula for calculating the return on assets. Now let's go find our numbers. Now for the after-tax operating income, we have a formula to calculate it as well. And that formula is 1 minus tax, which is the tax rate. Let's call it tax rate. Okay, multiplied by the interest expense and then we add net income. Okay, so I have expanded my numerator here. All of this is going to be at the top of my fraction, and then average total assets is going to be total assets at the beginning of the year plus the total assets at the end of the year, and then we'll divide them by 2, just like we've done with the average shareholders' equity in the previous part. Okay, so I'm just going to write average total assets for now, and we'll go and find our numbers. One minus the tax rate. We'll go up here to the income statement, and as you can see here on this line on taxes, it says at 35%. So from this we can figure out that Phone Corporation pays a 35% tax. So 1 minus 0.35 multiplied by, again we'll go back to the income statement to find the interest expense right here. Interest expense 685, so I'm going to write that down, plus net income. Again we'll go back to the income statement, and as you can see here, net income is 1223. 1223. Okay, so that's all we need for the for calculating the after-tax operating income. But now we'll go back this time to the balance sheet to find the average total assets. So right here we have our total assets at the beginning of the year, 27,503. 27,503 plus total assets at the end of the year, 27,714. And then we'll divide them by 2. Okay. All we need to do now is just run the numbers on a calculator. So first I'll open a bracket, 1 minus 0.35, close the bracket, multiplied by 685 equals 445 plus 25 plus 1,223. So my after-tax operating income is 1668.25. Okay. And then for the denominator, 27,503 plus 27,714 divided by 2, that gives me 27,608.5. Okay. 1668.25 divided by my previous answer will give me 0.0604. Again, another profitability ratio, return on assets, so I'm going to make sure I express it in a percentage. So that will be 6.04%. Okay. So Phone Corporation's return on assets is 6.04%. All right. And again, how you interpret this, the higher the better. So as we have mentioned in the lecture, interpreting ratios is always relative. So you always have to compare it against something else. Whether you compare it against the company's performance in previous financial periods, or you compare it to a competitor's return on assets, or you compare against the industry average. Okay. And then when you're comparing, if your Phone Corporation return on assets was greater than whatever you're comparing with, that's a good indicator. If it was lower, then that would be bad. So it's difficult to evaluate ratios on their own. You have to always measure them against something else. Okay. Except for liquidity and solvency ratios, we'll talk about that once we get to them. All right. So let's see the next one. Part C. It says return on capital. Use average balance sheet figures. So again, we'll write down our formula. Return on capital, ROC, equals excuse me, after tax operating income divided by long-term debt plus shareholders equity. Okay. Now this is also requiring us to use the average, so maybe I should have written average long-term debt plus average shareholders equity, but we'll just do that in our calculation right away. Now the after-tax operating income we have already calculated in the previous parts right here, because it's the same as you notice for return on assets. So I'm just gonna copy the number again. I'm not gonna redo the calculation. So 1668.25. But now for our denominator, we're gonna have to do some calculations, because we're gonna have two sets of numbers for each of these. Okay, so we're gonna have long-term debt at the beginning of the year and long-term debt at the end of the year. Same thing applies for shareholders equity, at the beginning of the year and at the end of the year. So we'll take the average of both, add it together. So where's our long-term debt? We'll come here to our balance sheet. Here's the long-term debt and leases. This is the end of the year figure, 7018. And this is the start of the year figure, 6833. Okay? And for our shareholders equity, same thing. This is the end of the year figures, 9,724. And then at the beginning of the year, 9,121. All right. So what I'm going to do, I'm just going to take the average on my calculator right away. Here, let's just write it down. So for the start of the year figures, it's going to be 6833 plus 9121. 6833 plus 9121 plus, and for the end of the year, 7018 plus 9724. 7018 plus 9724. Okay, close that down, divided by 2. Alright, now run the numbers on my calculator. I'll open a double bracket, 6833 plus 9121, close the first bracket, plus, open another bracket, 7018 plus 9724, and close both brackets, and now divide by 2. That gives me 16,348. And again, I'll just copy the after-tax operating income, 1668.25. Okay. Excuse me. I put the comma in the wrong place. 1668.25 divided by my answer. And that gives us 0.1020. Again, you would want to express this in a percentage format because it's a profitability ratio. All right. And the outcome, or our final result, is that for Phone Corporation, their return on capital is 10.20%. Okay. All right. Now let's go back to the question and see the remaining requirements. Next one, D, days in inventory. Now, for this time, use start of the year balance sheet figures. So again, as always, let's write down the formula first. Let's put it in red. Days and inventory. Now this one is not a profitability ratio. Now we moved on to the following category of ratios. This is an efficiency ratio, and we calculate it by dividing the inventory. And we're gonna take the inventory figures at the start of the year based on what the question wants. So I'll just write start of year. Okay. And we'll divide that by the daily cost of goods sold. Daily costs of goods sold. Okay. Now let's find our numbers. The inventory at the start of the year, that's going to be on the balance sheet. So let's go to the balance sheet right here. The assets section, inventory at the start of the year is 238. Whereas the daily cost of goods sold, we're going to have to calculate that. We're going to find our cost of goods sold on the income statement, but to find the daily average, we're going to have to divide that figure by 365, which is 365 days in 1 year. But first, let's find the cost of goods sold on our income statement right here. Cost of goods sold, 4060. So I'll open a bracket here, 4060 divided by 365. Okay. Now let's run the numbers on a calculator. 238 divided by, I'll open a bracket, 4060 divided by 365, and close my brackets. Okay. And this gives me 21.39655. So I'm going to round that up to 40. Okay, you could say something like rounded right here to show that you have rounded your figures if you want. Okay. But this is in days, right? What does this mean, days in inventory? This means, or this specific ratio tries to assess how quickly or how efficient the company is in or how long it takes the company to sell their inventory, right? And the answer here that the average for this particular company is that it takes them 21 days, just over 21 days to sell their inventory. Okay. Let's go back to the question and find the next requirements. Part E, inventory turnover. Again, use the start of year balance sheet figures. Inventory turnover ratio. This one we calculate by dividing the cost of goods sold by the inventory. Again, we're using the inventory at the start of the year, so I'm just going to write that. Okay. We already have our figures, so I'm not going to go back to the income statement and the balance sheet to find the numbers. We already have them right here. So this is the inventory at the start of the year, and this is the cost of goods sold. But we're flipping them. So we're going to have 4060 here at the top, our cost of goods sold, and 238 at the bottom. And that's going to give us the inventory turnover ratio. Run the numbers on a calculator. 4060 divided by 238. That gives us 17.058. So I'll just round it up to 06. Sorry. Okay. All right. So this is our turnover ratio. Now let's go back and see what's next. F, average collection period. Use start of the year balance sheet. F, average collection period. Now, when we refer to collection for a company, we are referring to the company collecting their money from their customers. Okay, so the company has accounts receivables, they sell products, and they record that under their accounts receivable account, and then they have to collect that cash, right? So we want to assess how long it takes the company to collect that money, right? And the formula for that is we take the receivables account let's see, is it does it want us to take the average or the beginning? Right here, yeah, we're taking the start of the year, so I'll just write receivables at start of year. Okay, and we'll divide that by daily sales. All right, now where can we find these numbers? We'll go up. Our receivables is going to be in the balance sheet under the assets section. Okay, and the receivables at the start of the year, 2490. Equals 2490. And then we want daily sales. We're not going to have daily sales on the reports, but we can calculate it by taking the net sales figure, 13,193. 13,193. And dividing this by, dividing this by the number of days in 1 year. So 365. Okay. Now let's find the average collection period, 2490 divided by, open a bracket, 13,193 divided by 365, close the brackets, and that gives me 68.888. So I'm going to round that up to 68.89, and that is in days. So on average, it takes this company, Phone Corporation, about 70 days, so just under 70 days, to collect their accounts receivable. Okay. Now for the collection period, you want to see a smaller number. You want to see this as small as possible, because the smaller this number is, the better the company is at collecting their accounts receivable. Okay, and that refers to the topic of cash conversion cycle. You want, or companies typically want to make their cash collection as short as possible, and their cash disbursements, the money that they owe to other entities, that they need to pay to other entities, take as long as possible. Okay, so you want to shorten the side that you're dealing with your customers and collecting money from them, and extend the duration of the time it takes you to pay your vendors. All right. Okay, now let's go back and see what's next. G, operating profit margin. Operating profit margin equals the after-tax operating income, divided by net sales. Okay, so we want to express our after-tax operating income as a percentage of our total sales. Okay, and that is going to show us how much of our sales dollars, or from each dollar sold, is going to go as an after-tax operating income. All right. Okay. So let's find our numbers. The after-tax operating income we have already calculated earlier, so we're just going to take from there, right here, 1668.25. 1668.25, and then its sales figure is going to be right here on the income statements, the top line of the income statements, 13,193. Sorry. Okay, run the numbers. 1668.25 divided by 13193. Okay, and this gives me 0.126445. So I'm just gonna round this up to 65. Okay. And for the operating profit margin, similar to the profitability ratios, you want to express it in a percentage format. So I'm going to do that. That's going to be 12.65%. All right. So from each dollar of sales for this company, Phone Corporation, 12.65% of that is going to go as an after-tax operating income. Okay. All right. Next one. H, long-term debt ratio. Use end-of-year balance sheet figures. Okay. So for H, we're going to try to calculate the long-term debt ratio. Which is going to be the long-term debt divided by the long-term debt again plus shareholders' equity. Okay. Now the question wants us to use end of year balance sheet figures. So let's go up to the balance sheet and see our numbers. Our long-term debt is right here. And this is the end of year column. So our long-term debt is going to be 7018. So that's going to be 7018 divided by 7018 plus shareholders' equity at the end of the year, which was 9724. 9724. Okay. 7018 divided by, open a bracket, 7018 plus 9724, and that is 0.4192. Okay, rounded. Okay. All right. And that is going to be our long-term debt ratio. Now, the long-term debt ratio is one of the financial leverage ratios, or what we call solvency ratios as well. And these group of ratios are a little bit interesting. These might be the only group of or category of ratios that you don't want them to be either too low or too high. Okay? For other ratios, it's typically the higher the better or the lower the better. Either or. Okay? But for financial leverage ratios, typically you want your company to have or to be within a certain range, because too much debt and it's dangerous for the company. They might not be able to meet those long-term financial obligations, and too little debt means that the company is not really utilizing debt to their advantage. They're not using debt to maximize their profitability and returns. All right. So you want these ratios to be somewhere in the middle. And how do you judge that? Again, you don't evaluate ratios individually. It has to be compared to something else, either the company's performance in previous financial periods or a competitor's ratio or an industry average. If you have enough data to find the industry average, that's even better. Okay? All right. So let's go back and see the next one. We've done H. Okay. I, total debt ratio. Use end of year balance sheet figures. Okay. I, another financial leverage ratio. Total debt. And for the total debt ratio, it is calculated by the total liabilities. Total liabilities divided by total assets. Okay. Now we'll go to the balance sheet and find our total liabilities right here. And the question wants us to use the end of year balance, so we'll stay at this column right here. And here, as you can see, we have our total current liabilities. We have long-term debt and lease, okay, or debt and leases, and we have other long-term liabilities. So all these three combined are going to be our total liabilities. Okay, so I'm just gonna add them all up on my calculator. 4794 plus 7018 plus 6178. Okay, so that's total current liabilities, the long-term debt and leases, and the other long-term liabilities. Okay, I'll write the number down. It's 17,990 divided by total assets. Total assets is going to be given right away on the balance sheet right here, 27,714. 27,714. Okay, now just run the numbers on a calculator. 17,990 divided by 27,714, and you'll get your answer. That will be 0.6491. Okay. If you want to round that up to 3 decimal places, 2 decimal places, that's fine. For me, typically for ratios, I like to stick to a 4 decimal place representation as much as possible. Okay. Okay, so that will be our total debt ratio. Now, what does this mean? How do we interpret this particular ratio? The company's total liabilities represent 0.6491 times of their assets. Okay, so for this one, it might be even better to express it in a percentage. So I'll just express it in a percentage right here. And that means that the company's total assets are funded 64.91% by debt, okay, by liabilities. All right. Okay, let's go back and see the next requirement. J, times interest earned. J times interest earned equals, that's going to be EBIT or earnings before interest and tax divided by interest payments. Okay. Now EBIT is going to be given right away on our income statement. Right here, earnings before interest and taxes, EBIT 2566. So I'm just going to copy that. 2566. And the interest payment as well is given right away on the income statement, which is the interest expense. Same thing right here, interest expense 685. Okay. So I'm also going to copy that down. 685. Run the numbers. 2566 divided by 685. That's going to be 3.74598. So I'm going to round that up to 746. Okay. All right. What does this mean? This is the company's ability to use their earnings before interest and tax to cover or to service their debt interest payments. Okay? How able or how many times over can the company use their earnings before interest and taxes to pay the interest on the debt that they carry? Okay? And the answer to that question is 3.746 times. Okay. Next one. There's one right here hidden. This should have been on the second line, but anyways, this is part K or requirement K, cash coverage ratio. Cash coverage ratio is going to equal the same exact formula that we used to the times interest earned right here, but we're going to add depreciation. So we're going to add back our depreciation expense to the earnings before interest and tax. Why are we going to do that? Because depreciation is a non-cash expense. So it serves as well to see how does the company's ability to pay the interest on their debt if we consider excluding the depreciation expense from our calculation, right? So basically, when we wanted to calculate earnings before interest and tax on the income statement, you will see that we don't get to this number unless we subtract depreciation. Let me show you. So we have net sales, cost of goods sold, other expenses, and then we also deduct depreciation, and then we get to earnings before interest and tax. Now, the cash coverage ratio says, okay, you have your earnings before interest and tax, but you need to add this back to it because depreciation is a non-cash expense. Okay, so add it back to the EBIT and then see how many times over you can pay your or cover the interest payments on your debt. All right. While we add it, let's see how much is the depreciation expense. It's 2518. 2518. Oh, we haven't written the formula yet. Okay, let me copy this. Okay. Plus depreciation equals EBIT, we already know, is 2566 plus Our depreciation, I think it was 2588. Let me just double check. Oh, sorry, 2518. 2518. 2518. And then the interest payment we also already know from the previous part, 685. Okay. 2566 plus 2518. Add them up and then divide by 685. And we get 7.42189. So I'm just gonna round it up. Okay. That's also times. So if we take into consideration that depreciation is a non-cash expense, the company has the ability to use their earnings before interest and tax to pay the interest payments on their debt 7.422 times. Okay, so this is a multiple. All right, next one. Current ratio. Use end of year balance sheet figures. All right, so this is an easy one. L, current ratio. Now we moved on from the financial leverage ratios to liquidity ratios. Current assets over current liabilities. Okay. This is a liquidity ratio that measures the company's ability to meet its short-term obligations. So unlike solvency ratios or leverage ratios that focuses on the company's solvency or ability to meet its long-term obligations, this one focuses on, or this group of ratios, liquidity ratios, focus on the short term, right? Okay, so let's go back and find our current assets and current liabilities. And we're going to use end of year numbers. So the current assets right here, total current assets, end of year 3525. And the current liabilities 4794. Okay, so 3525 4794. I think, let me just double check. I have a bad memory. Where is it? Sorry. Yes, 4794. Okay, good. Okay. Run the numbers. 3525 divided by 4794. And we get 0.73529. So I'm just going to round it up. Okay. You could also express this in a percentage format. All of the ratios, you can do that. But it makes more sense in some ratios than others. So I don't typically do it for all of the ratios. For the current ratio, it measures the company's ability to use its current assets to pay their current liabilities obligations. So the short-term financial obligations. So having a current ratio that is less than 1 is typically a red flag for you as an analyst or as an investor or as a financial manager, because it means that the company cannot cover all of their short-term obligations, remember the liabilities that they need to pay within 1 year or within one accounting cycle, using their current assets. So that means they either gonna have to sell some long-term assets or maybe take on some debt or whatever they might want to do in order to cover. So you always want the current ratio to be at least 1. Okay, bigger than 1 is good. A very high or a very high number is not that good, because it means that the company is not really efficient. But at least you want it to be over 1. Okay. Next one, I think it might be the last one. Yes, right here, quick ratio. We're also going to use the end of year balance sheet figures. Now for the quick ratio, it's also another liquidity ratio. Okay, and it's similar to the current ratio. However, it excludes inventory from the consideration. So when we use current assets, we are including all of the different current assets accounts, including inventory accounts. So we are taking into consideration that we also going to need to sell some inventory in order to meet our current liabilities. The quick ratio takes out the inventory from the current assets. Okay, so some analysts calculated using current assets minus inventory, but we're gonna follow the formula that's in your textbook, which is another way to calculate it, by cash and marketable securities plus accounts receivable. Now it depends on the company. Most companies put these all in one account on the balance sheet, the cash and marketable securities, and many companies don't. They would have the cash and cash equivalents or something like that, or maybe just cash account and then marketable securities on a separate account. So it depends. But as long as you understand that you're going to need to add all of the highly liquid current assets and eliminate inventory, because inventory you're going to need to sell it first in order to use the cash to pay your short-term obligations, right? And in the denominator, it's the same. It's the current liabilities. Okay. Now, knowing how we calculate the quick ratio, you should also know that, or if you pay close attention, you will see that the answer here that we're going to find is always going to be lower than the current ratio. Okay? There's only one case scenario where they would be equal if the company is not holding any inventory at that moment. But that is a very highly unlikely scenario. Okay? The typical situation is that the quick ratio is always going to be less than the current ratio. Okay? So keep that in mind. All right. So let's find the accounts. Cash and marketable securities and receivables. Those both are going to be on the balance sheet right here. Cash and marketable securities, end of year, 89. Receivables, 2382. $89, 2382 over current liabilities, which we have already found in the previous part, which was 4794. So I'm just gonna cheat it right off that and run the numbers. 89 plus 2382 divided by 4794. And that gives me 0.5154, okay, or you could say 51.54%. And as you can see, it's a lower number than the current assets, or the current ratio, sorry. All right. Now, what does this mean? It means that if we ignore the company's inventories, using the company's current assets, excluding inventory, we can only cover 51.54% of our current liabilities, which might be a problem for the company. All right? That means that the company is not very liquid, and they would struggle to meet their short-term financial obligations. Okay? That is it for this exercise. I know it was long. I tried to be as thorough in my explanation as possible. That includes writing the formulas down and showing you where to get the numbers and showing you how to interpret each of these ratios. What do they mean? Hopefully you found this useful. If you still have any questions, please feel free to drop them down in the comments. Otherwise, until I see you in the next exercise tutorial, inshallah, keep on learning, and I wish you the best of luck. Take care.